to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Every character building experience I've had mostly build character I didn't order. Work-life balance is just corporate rebranding for please don't quit. We call it a correction when stocks fall, as if they were the ones making a mistake. Transparency in government usually means you can see right through the excuses. In sports, momentum is just what commentators say when they've run out of data.
Big Tech's $100 billion AI arms race. Big Tech's AI spending chart now looks less like an investment trend and more like a vertical takeoff. Meta, Alphabet, Amazon and Microsoft are burning through billions faster than GPUs can cool down. And somehow it's still not enough. Meta has gone full casino on the metaverse's smarter cousin, while Microsoft quietly buys every chip Nvidia hasn't already promised to someone else. Alphabet's playing catch up, and Amazon, well, someone's got to host all this chaos in the cloud. Nvidia's market cap crossed $5 trillion. That's a trillion with a T, putting it within arm's length of the entire Indian stock market. One company that sells chips is now worth almost as much as 6,000 Indian listed firms combined. Let that sink in. India has a billion plus people, hundreds of industries, and an economy growing faster than its cricket commentary. And it's still about to be overtaken by a firm that makes the hardware running your AI memes. At this rate, Nvidia might soon need diplomatic status. If this chart had a sound, it would be someone gasping in Mandarin. The effective tariff rate on China has shot up to nearly 40%, making imports from the world's largest factory suddenly look like a luxury hobby. Even after the so-called deal, the recent deal, rates may settle just around 30%, still miles above everyone else. Meanwhile, tariffs on the rest of the world barely twitch. Southeast Asia gets a break thanks to electronic exclusions, and India remains a little bit of an outlier, but with its own diplomatic subplot, which hopefully should get resolved soon. This chart is basically the story of capitalism discovering Wi-Fi. In 1985, America's biggest companies pumped oil, built cars, and made film rolls. By 2025, they are all selling pixels, data, and dreams. Kodak's gone, Exxon's downsized, and the new royalty is a bunch of code, with Apple, Microsoft, and Nvidia sitting on thrones made of silicon. The top 10 share of S&P 500 has ballooned from just 15% to nearly 35%, meaning the market's diversity now rivals a Silicon Valley cafeteria. Its innovation is at full throttle, or concentration risk is on steroids, depending on how you look at it. If investing were cricket, gold would be that player who bats slowly, never looks flashy, but somehow ends up top scoring. Over the last 20 years, gold's returned 15%, while stocks have managed 13.5%. Not bad for something you dig out of the ground. But rewind just a year, and it's a different match. Stocks were ahead, gold was lagging. The scoreboard changes fast, and every expert suddenly sounds like a commentator explaining why their prediction almost worked. Please also remember, this is a comparison with the index, not with individual stocks. After years of doing absolutely nothing, industrial metals are suddenly threatening to break out, like teenagers who suddenly discovered cocaine. Copper, aluminium, zinc, all knocking on multi-year resistance levels, and silver's flirting with its 1980s high, like it's back in disco season. The setup looks eerily like gold's rally last year, a supply overhang finally thinning out, investor flows heating up, and traders whispering supercycle and again supercycle like it's a secret spell. Here's a fun twist. Despite every wedding, festival and family WhatsApp group proving otherwise, data says India's love for gold has zero impact on consumption. According to systematics, household spending doesn't move with gold prices at all. In economist speak, the correlation is statistically insignificant. In plain English, your mom buying more bangles doesn't boost GDP. What does matter is income. For every 1% rise in real income, Private consumption just jumps just about 0.65%. Inflation, interest rates, and even the Sensex all big players in this drama. India's external commercial borrowings, or ECBs, basically corporate India's offshore credit card, has dropped nearly 25% year on year in the first 5 months of FY26. That's about $16 billion, which sounds like a lot until you remember how much Indian companies like borrowing abroad when the math works. The problem? The math has more or less stopped working. Lower domestic interest rates and a weakening rupee has squeezed the arbitrage trade, meaning the easy money game isn't so easy anymore.